it turns out that when you and this is surprising even to a lot of economists, but when you look at the pre-Fed and post-Fed system, it's not obvious that the central bank has improved matters. That is, it's not clear that the central bank has done a better job, say, smoothing out macroeconomic fluctuation or promoting long-run economic growth, and certainly they've done a worse job on the price stability front. It's much harder to predict the purchasing power of the dollar today than it was under the gold standard.
All right, so hi everybody, welcome to Liberty Curious. I'm Kate Wand. I'm here with William Luther, who is the director of the Sound Money Project at AIER, as well as associate professor at Florida Atlantic University. Nice to see you, Will. How are you doing today?
Good to see you too. I'm doing well.
Great. So I was thinking today we could get into kind of the mess that the Fed has been making around inflation. And you've done a research paper on this that I believe was published today. So maybe we can talk a little bit about your research and what's been going on there.
Yeah, that sounds good.
So has the Fed, first of all, have they reached their targets on inflation? Because I know that they have these regular targets and that's what they try and go by. But it seems that maybe they've not been meeting those targets for the last couple of years?
Yeah, I think that's more than fair to say. So, the Federal Reserve adopted a 2% inflation target in 2012. And it's modified that target a bit over the years. In 2016, it clarified that target was symmetric, meaning that if that it wasn't trying to it wasn't treating that as a maximum inflation rate. Back then, the concern was that inflation was too low, not too high. We might refer to that as the good old days now. So they'd clarified that they were thinking about that as a symmetric target, and any deviation from 2% was an error and not a systematic bias. And then in August of 2020, they modified their target to clarify that it was an average inflation target. And this was, at the time, I thought, an improvement in the Fed's targeting regime. One problem with an inflation target is that if you have a real disturbance like a pandemic, then we should expect prices to rise. Supplies are constrained, and so prices will rise temporarily, and then they'll come back down when those supplies return. And so if you're ensuring that inflation is 2% in every period, you really undermine the market's ability to allocate resources because you make it difficult to reflect that economy-wide disturbance. And so the Fed adopted this average inflation target in August of 2020. And basically they said, we're going to allow prices to rise a little more rapidly in response to supply disturbances, or perhaps not rise so quickly if there's a surge in technology. But over the long term, inflation is going to average 2%. So you can build this into your expectations when you're, say, entering labor contracts or long-term purchase agreements or loans. You can come to expect that inflation is going to be 2%, and so you'll have a pretty good idea of what the dollar will be worth at some point in the future. Mm-hmm. So that was the plan. Of course, reality has fared far differently over the last year or so. So beginning in March of 2021, the price level exceeded that 2% trajectory projected from January 2020, that is just prior to the pandemic. Mm-hmm. So, we all recognize that the pandemic was this big unexpected event. So we might say, let's see, how prices would have evolved over this time if the Fed had hit its 2% average inflation target. So we'll project out from that date. And prior to March 2021, prices were below that trajectory. In the time since, they've grown pretty rapidly, again passing that 2% trajectory in March of 2021, and then really beginning to accelerate in September of 2021. So today, right, the newest personal consumption expenditures price index data has come out for April, and since January 2020, prices have grown at a continuously compounding annual average rate of about 4%. And so that means that prices are about 4.7 percentage points above where they would be if they had just grown at that 2% average inflation target.
And so, they were pretty late to acknowledge that there was a problem going on, correct?
Yeah, that's right.
Yeah. And why? Why do you think that they were late to acknowledge that problem?
Well, part of this just has to do with the difficulty of conducting monetary policy. The pandemic was this big, unprecedented event, and initially prices were below the trajectory, and so it just took some time for that data to be collected and for them to assess what was really going on. So if you were to go back to, say, July of 2021, that's when they realized that in March prices were somewhat elevated, and that in April they had surpassed where they were in March. And so that data is coming in with a lag, and they're realizing that prices are above that 2% growth path, but they're not very very far above that 2% growth path. And of course, we'd had this big pandemic, and so it was reasonable at that time to think that prices were merely elevated because of the supply disturbances that we were dealing with. And if you look at statements that the FOMC released, it's pretty clear that from the summer there of 2021 through September, that they are attributing this high inflation to supply disturbances. They describe it as transitory, which at the time we thought meant that prices would come back down when those supply constraints eased up. And they just held on to that narrative until November. And certainly by then, that was really difficult to square with the facts. Real output was recovering, so those supply disturbances were clearly easing, and yet rather than coming back down, prices were accelerating. Yeah. And so at that point, they had no choice but to abandon that transitory narrative, and so that's what they did. So reasonable people can disagree about when they should have recognized that there was a problem. And why they waited so long to acknowledge that. Yes. But certainly by November, it was clear that transitory narrative was dead.
Now, there could also be, they blamed it on supply disturbances, but of course there's also all of the money printing that comes into the calculation of inflation. Is that not true?
Well, that's right. The fiscal authority cut checks to households, propped up some businesses that otherwise would have failed due to the pandemic, and perhaps that was the right thing to do. Right? The government shut down the economy for months, and those businesses didn't really have a choice, right? And so if you're going to force them to close, then there would seem to be some obligation to provide them some support for the, given that you've inflicted this pain on them. But the Fed, accommodated all of that fiscal expansion, and if we were to look at how well the Fed did, say through January of 2021 or March 2021. Then that looked reasonably appropriate. The problem is that when spending really started to take off, that's the point where the Fed should have said, well, we have potentially done too much here, and so we want to keep an eye on nominal spending. And if it is picking up as we suspect it is, then we need to cut the growth rate of money to bring that nominal spending back down to prevent demand-driven inflation. But the Fed didn't do that. Instead, it held on to this transitory narrative well into the fall. And then even when it abandoned that transitory narrative, it really didn't begin conducting monetary policy in a way that would bring down nominal spending until May of 2022. So that seems like a pretty long delay. The Economist magazine joked earlier in the year that the Fed was depending on an immaculate disinflation. That is, just really hoping that that inflation would come down on its own.
Yeah.
Because certainly the Fed wasn't doing anything to bring down inflation.
Okay, so this is what brings me to the Fed's original mandate, which is basically what? What is their original mandate? There's two things, right?
Yeah, the Fed is tasked with providing price stability and full employment. Now, in the long run, the only way that the Fed can affect employment is by providing price stability. That is, ensuring that the dollar is relatively stable over long periods of time so that individuals can make appropriate decisions about how much to produce and how many labor hours to supply. Economists say that in the long run, money is neutral. And what that means is that monetary policy isn't going to affect our ability to produce to any real degree in the long run, beyond just providing some monetary stability. And so these objectives are, at least over long periods of time, in sync. The Fed can promote full employment by providing monetary stability or price stability.
All right. So they kind of missed their mandate.
Yeah, they missed their mandate. They have failed to provide price stability, and they've done so in part by fooling people into overproduce. Now that's sounds a bit strange when you describe it as it's normally described. That is, unemployment is or has been too low, or production has been too high. That seems a bit weird to most people, and certainly we're not saying that the Fed should cause people to lose their jobs or anything like that. But we're just recognizing that, if we were all fully informed, we would make decisions about how much to work. And over the last year or so, we have expected prices to grow at a rate that is less than they've actually grown. And so we made our decisions about how much to work and how much to produce over that time with incorrect information about the value of the dollar. Mm-hmm. And so some of those labor hours that we supplied, we would have perhaps not supplied if we'd realized that the dollars that we were getting just weren't going to purchase as many goods and services as we expected they would. So if we had had better information, we would have chosen not to work so many hours, not to produce so much over the last year. Our production instead would have been in line with the real reduction in our ability to produce that came about as a result of the pandemic. And so, it's tempting to think that producing more or working more hours is always good, but it's not good if you're only doing that because you think the dollars you're going to get for that production and for that labor is going to buy more goods and services than it will actually buy. And so we're overproducing there.
I kind of picture somebody who's hired an employee in their small business, and then that employee doesn't really have anything to do, right? Like as a business owner, you're spending more money on this employee, and that's going to affect things when that person is just standing there not actually working. So I kind of see what you're saying there with that. So if they kind of if they fail on the first point, then the second one will be affected that way. So it's not necessarily a better thing to have more employment if the circumstances don't foster that kind of environment.
Yeah, I think about my own personal situation. I have a family, and on the margin, I would be happy just to spend the weekend playing with my kid at the park. Mm-hmm. But if there is a big opportunity to pick up some additional hours and earn a lot of income, that's good for my family as well. And so if the offer is sufficiently high, then I will reluctantly sacrifice some of that time with my family in order to engage in that production.
Yeah.
But if then I get those dollars and go to spend them, and they just don't buy very many goods and services, then I'm going to be disappointed. Right. I will regret that I hadn't just spent that weekend playing with my kid. This happens to very small degrees all the time, and we don't always connect the two because inflation is this thing that just kind of happens out there that most of us don't have a good idea of why it's happening.
Yeah.
And so it's not always so clear that we should regret the decision to work more. Instead, we usually just express our frustration that the prices are higher. But if we had known that the prices were going to be higher, then we wouldn't have engaged in that marginal production. And so we don't always channel that disappointment in the right way. But certainly some of us have worked too much,
yeah.
More than we otherwise would have over the last year or so if we had known what those dollars would actually purchase.
Right. So then your income is actually smaller in a sense because relatively you're not able to purchase as much with it.
Yeah, that's right. So we see nominal wages, that is, wages that aren't adjusted for inflation. We've seen those pick up over the last year. And, naturally, workers see those higher nominal wages and they, some folks who otherwise wouldn't have worked decide to work. And some folks who would have worked less, they decide to work more because firms are offering more dollars. Mm-hmm. But if we adjust those wages for inflation, then we see that real wages or inflation-adjusted wages have actually declined. And so although nominal wages have picked up over the last year, they haven't picked up for most workers to the same extent that prices have risen. And so that's that misperception there between nominal prices, nominal wages, and the prices that we'll ultimately pay is what's fooling people into working too much and producing too much.
Yeah, that makes a lot of sense. And so, that's basically based on the projections that the Fed had, which were wrong, but then they didn't change their plan. Actually, they didn't say, oh, let's redirect, let's change course until, when was it? In March, you said, or April 2022?
So just the overview here, in December of 2021, the Fed, it had finally given up on this transitory language. It made projections of inflation for the next year. And almost as soon as they made those projections turned out to be very optimistic. In January, in February, in March, prices were just rising far too rapidly to be consistent with the Fed's projection. And the Fed clearly recognized that prices were rising more rapidly than it had expected, because in March it revised its projections for the year. And so the Fed was aware in December that inflation was a problem, and it had had set this course of policy where it would raise the federal funds rate target by 25 basis points in March. But then as time unfolded, first, that's, it could have made this decision to raise its target rate in January. It could have scheduled an emergency meeting for February. So already we have kind of a long delay here in the Fed's plan. But even if we take that initial plan as given, the Fed was getting new information over this period of time, information that was showing the Fed that actually the inflation problem is even worse than it expected. And the Fed did not revise its plan. It just made that 25 basis point move in March, revised up its projections for inflation for the year, and also didn't really take serious action until May. And so, we have this problem that the Fed identified in December that it found out was worse than it had expected in January, February, and March. And yet it doesn't really take serious action to deal with this until May. So it's very late to begin dealing with the inflation problem. And even then, its moves have had a pretty small effect on expected inflation over the 5 and 10-year horizons. So it seems like market participants do not expect that the Fed has done enough yet to bring down inflation.
Yeah.
And they're also not super confident that the Fed is going to do enough to bring down inflation anytime soon.
Yeah, that's something to really, a point that should really be noted, is that it seems like they're not going to do enough to counter it. And so again, they're failing on their official mandate. And so what I would like to know is, are there any kind of incentives that the Fed would have for allowing inflation to continue on this way?
Well, it's worth noting that the Fed is failing based on two different standards. So if you think about that average inflation target, if the Fed were serious about that, then it would mean that what it would need to do is to bring inflation down sufficiently so that inflation averaged 2%. Over this period, that is including the period where inflation has been above 2%. So we would need a period of time where inflation is less than 2% in order to bring prices back down to where they would have been if they'd averaged 2% over this period.
Yeah.
The Fed has basically abandoned that view. It's just going to let bygones be bygones here, and now it's just trying to bring inflation back down to 2%. So it's failed
Right.
in terms of that strict task of averaging inflation over the period where inflation has been too high.
So would
previously.
that be, sorry to interrupt, but would that be kind of like a compounding inflation then versus the average inflation?
Well, it means that the effect on the price level that we've seen over the last 14 months is going to be permanent or largely permanent. That is, if the Fed succeeds at its revised task at just bringing inflation back down to 2%, then we're going to be on a higher price level trajectory. So prices will remain elevated, but then they will grow at 2% in the future. The bad news is that the Fed appears to be failing to accomplish even this revised task. That is, if you look at market expectations of inflation, they're above 2% for the 5-year horizon and the 10-year horizon. So markets are expecting, not only that the Fed is not going to bring prices back down to where they otherwise would have been had we not had this high inflation period, but they're not even going to bring inflation down to average 2% going forward over the 5 or 10-year horizon.
Wow.
And so, right now, markets are expecting inflation to average around 2.7% over the next 5 years, and around 2.2% over the next 10 years. Most of that above average inflation will be in the near term, over the next year or two. But we're going to continue to see high rates of inflation for the next year or two, and then inflation will return to 2%. But it's not going to happen very quickly.
Right. And do those projections that you just mentioned, do those numbers come from the Fed or from other sources?
So the numbers that I just mentioned are coming from bond markets. So my student Morgan Timon and I look at the spread between traditional treasuries and inflation protected or inflation indexed treasuries. And so that gives you a decent estimate of how much bond traders are pricing in terms of inflation over the 5 and 10 year horizon. The Fed issues projections for inflation over when it meets each quarter, and so its most recent projections are from March, and I believe it was projecting, if I recall correctly, around 4.3% inflation for the year. At this point, I would be surprised if inflation is below 6% for the year. It looks likely that when the Fed meets again in June, it's going to revise its projections up further, because the price level has just grown much more rapidly than its projection would have suggested.
I read a really great article from AIER the other day. Somebody had written about the wokeification of the Fed and how it seems that, they're steering their ship towards some other political values. And could that be something that's getting in the way of them dealing with this inflation problem?
Well, certainly what we want, given that we have a central bank that is tasked with managing the dollar, what we would like is for that institution to be narrowly focused on doing that job well, because it's an important job. Some have suggested that because that's a somewhat boring job, or has been a somewhat boring job over the last decade or so, that Fed officials got distracted. We see this also with other central banks like the ECB. They've been looking much more at issues of climate change and inequality, and if you want to pursue those ends, there are avenues for doing so. In the U.S., that should be taken up by Congress, but the Fed has dipped its toes in the water here, in terms of thinking about how its regulatory efforts might be able to limit climate change, or the extent to which it can conduct monetary policy to reduce inequality. And the problem is just that that's not part of the Fed's job. It's not obvious how the Fed would conduct monetary policy appropriately to reduce inequality. That's really driven by structural issues that the Fed just doesn't have good tools to deal with. And the risk, which I think many people are coming to realize, is that when the Fed devotes its attention to these other things, it's taking that attention away, at least on the margin, from its core mission of providing price stability.
Yes.
And so perhaps as a consequence, it's let prices grow rapidly over the last year, and we're dealing with the consequences of that.
And the Fed is supposed to be partisan, correct? They're not supposed to be political.
So the Fed is supposed to be independent. It's the board. The board members are appointed by the president and confirmed by the Senate. Other members of the Federal Open Market Committee, the regional reserve bank presidents, they're appointed by their bank boards and confirmed by the board of governors. But the idea is that monetary policy is too important to be corrupted by the political process. We don't want an administration to conduct monetary policy to improve its election odds. Instead, we want an independent central bank, which will take a very long run view of what monetary policy is best for the U.S. economy, and then conduct policy that way. So that's really the argument for central bank independence. Now, the Fed is, strictly speaking, not independent. Its officers, or many of its officers, are appointed by the president. And as we've seen quite clearly under the previous regime, the president can put pressure on the Fed to conduct monetary policy. So we shouldn't be deceived into thinking that it actually is independent. But there are reasons to think that independence would be good, or is something that is at least better than the alternative, which is a politically compromised, politically influenced Fed that delivers poor monetary policy.
Yeah.
So that's the idea there.
Yeah, well, that makes a lot of sense to me, and it kind of lines up with a thought that I've had, which is that it sounds kind of like the Build Back Better program might require the Fed to print money, to lend money at low interest rates all over, and to do things that are different than focusing on the task that is the best for the people, which would be to deal with those inflation rates.
Well, the government is a big borrower, and so they're certainly, the Treasury would prefer, politicians would prefer as well, for the interest on that debt to remain low. It also has, the government will stand to gain if inflation erodes the real value of that debt. So there may be a reluctance to raise interest rates. And there may be some political desires to see at least a temporarily higher rate of inflation to erode some of that real debt. And so I think it's reasonable to expect that pressure is there. But the Fed, it hasn't obviously succumbed to those pressures, at least to any meaningful degree. In the not so distant past. We had this period from the mid 1980s to today that sometimes referred to as the Great Moderation. Mm-hmm. Inflation was relatively low, with the exception of the Great Recession. Real GDP growth was reasonably strong. People might quibble about whether that real GDP growth was sufficiently strong following the recession, but by and large, monetary policy has been conducted reasonably well during that period. Again, excluding the Great Recession there, mm-hmm. And not obviously buckling to political pressure. Indeed, one of the big problems during the Great Recession is that inflation was too low. Individuals were being fooled into underproducing, the opposite problem that we have today. And so there seems to be some way that it resisted those political pressures in the not so distant past. And so it's possible that political pressure has creeped back in now, but it's not obvious why that is.
Yeah. Well, I think that anybody can think about those things and come up with a few answers for themselves. But one of the things that also has been on my radar is the CBDC. And I just saw yesterday, Brainard, who's the vice president of the Fed, she was having a Q&A with a bunch of senators talking about the central bank digital currency and a possibility of doing that for the US. And so if I look at it kind of from a broad angle, I would think, well, maybe if the US dollar continues to be debased this way and lose some of its value, they have a better argument for a CBDC.
Well, the arguments that Fed officials have put out for a CBDC are a bit strange, to be honest. One problem with the central bank offering a retail money like a CBDC is that it will take funds out of the private banking system. So you or I, today we have checking account balances. But if we had access to a central bank digital currency, which would allow us to make, similar transactions to the transactions we make with our checking accounts today, we might instead opt for that CBDC. And so banks would lose a major funding source. Those checking account balances would be diverted to the Fed, and that would imply that then the Fed has to allocate more credit than it is today. That's a concern. It's a concern because we don't really have any reason to think that the Fed can allocate credit more effectively than the private banking system. And so this could be a headwind for economic growth. Now, when pushed about this, Fed officials will say that they're not going to try and attract these customers from private banks. They'll say that they're going to pay an interest rate on these accounts that's less than the rate that they pay on reserves, and so banks will still be able to induce people to keep checking account balances. But when you reflect on what that means, it's kind of strange. Essentially, the Fed is saying that these central bank digital currencies are going to be so great, but nobody's going to use them.
Don't worry.
Odd,
don't
right?
worry. You won't need to use them. Yeah, that is
You can't
odd.
have it both ways,
Right.
right? Like either this is a great revolutionary technology, in which case a lot of people will want to use it, but also it will suck funds out of the private banking system, or it's not a great technology, and we don't have to worry too much about it sucking funds out of the private banking system.
Right.
But you can't simultaneously maintain that this is a great technology and we don't have to worry that people will use it.
Don't worry. You won't
a-
want it though. You won't want it. You won't have to use it. Yeah, that is a very weird sales pitch.
It reminds me of that old Woody Allen line, right? Nobody goes to that restaurant anymore. It's too crowded.
There you go. There you go.
Very similar here with the CBDC approach that the Fed seems to be taking.
Yeah, so there's a lot to delve in there with the CBDC, and I would love to have a discussion with you just on that specifically as well. But I'd like to bring that into another topic, which is sound money, because you're the director of the Sound Money Project at the American Institute for Economic Research, and so sound money sounds like the right thing, a kind of solution maybe for people to deal with inflation on a personal level and on a policy level. Would you like to speak to that a little bit?
Yeah. So, what we would like to have in a monetary system is a monetary system that has a predictable, a money that has a predictable purchasing power over the long run. So it's well anchored. But also that tends to mitigate macroeconomic fluctuation. So the supply of that money expands and contracts to meet changes in demand. That is the ideal. Of course, we live in the real world, and so most of the alternatives that we have access to fall short of that ideal. But recognizing the ideal gives us a way to evaluate those various alternatives. So, at the Sound Money Project, we write a lot about the central bank and the monetary policy that it conducts, of course. The central bank has the ability to anchor the long-run purchasing power of the dollar and to accommodate changes in money demand. But it hasn't been doing that. It's not providing a great anchor of purchasing power over the long run. And as we saw in the Great Recession, it's also not mitigating macroeconomic fluctuation, and we're seeing that today in the opposite direction. It's encouraging some overproduction.
Yeah.
We can look at some historical alternatives as well. So some of us on the Sound Money Project have written a fair amount about the classical gold standard.
Yes, you have a book on this, correct?
Yeah, that's right. We have a book that came out last year on the gold standards called The Gold Standard: Retrospect and Prospect. And that system anchored the long run purchasing power of the dollar reasonably well. But over short periods of time, it would respond to changes in demand. But of course, on a gold standard, you have to dig up that gold and bring it to the mint. And so the supply adjustments were relatively slow. It turns out that when you and this is surprising even to a lot of economists, but when you look at the pre-Fed and post-Fed system, it's not obvious that the central bank has improved matters. That is, it's not clear that the central bank has done a better job, say, smoothing out macroeconomic fluctuation or promoting long-run economic growth. And certainly they've done a worse job on the price stability front. It's much harder to predict the purchasing power of the dollar today than it was under the gold standard. And so we're selecting between two imperfect options there. And perhaps we would prefer one or both of those to work better. But that's the situation we're in.
Right. Well, the central bank was founded in 1913, right? So that was right on the tip of World War I. And that was, I think there was an ideological reason for that as well. There's the central planning model, and we can control the economy and we can run things best. A couple of people, the Federal Reserve is made up of 7 people, to run the economy for millions of people. And then there's the gold standard, which was more decentralized, private banks. And then of course there's Bitcoin. Do you have anything to say about Bitcoin?
Yeah, so if we think about those two features of a sound money, we can apply that to alternatives like Bitcoin as well. One advantage of Bitcoin is that its supply follows this pre-programmed mechanism. And so we always know how much Bitcoin is going to be in circulation at any point in the future with a very high degree of confidence. That has some positive attributes, but it also has some negative attributes, which is that it doesn't accommodate changes in the demand for Bitcoin at all. And so, the fluctuation in demand under the gold standard was accommodated very slowly, but slowly is better than not at all. Mm-hmm. And so we see big swings in the purchasing power of Bitcoin over short periods of time.
Right.
Now, there's a hope that if there were sufficient adoption of Bitcoin, that some of this fluctuation would go away. Yes. Because there would be much less speculation on the extent to which this is going to be used in the future. And instead, we would have much more confidence in the extent to which it's going to be used in the future. So some of that purchasing power volatility that we observe would decline. But we're still going to get routine fluctuation in demand, and much like we see with the dollar today or the gold-backed dollar of the past. And Bitcoin doesn't have a mechanism at present for dealing with that volatility.
Right.
And so it's one way of dealing with that volatility would be to have a banking system as a second layer on the Bitcoin primary layer. And so you would use Bitcoin for settlement between banks, and then banks could issue claims to Bitcoin, which could accommodate changes in demand to hold Bitcoin to the extent that those claims are close substitutes for the underlying base money. So these are certainly some of the things that we're thinking about at the Sound Money Project and writing about as well. Not just the system we have today, but systems we've had in the past and systems we might have in the future.
Yes.
That might have the potential to provide a more sound money.
Well, that's great. I mean, I'm personally somebody who thinks that Bitcoin has a lot of potential as well. I think the gold standard is a great thing to learn from. And I think that what's happening, what we're seeing too right now is some tension between moving towards that kind of sound money and that natural tendency to move into sound money after a period of relative stability, but a lot of control. This kind of innovation saying, well, let's find a better model, and having that on one end, and then having at the other end and governments and central banks saying, whoa, wait a second, we need to create a competitor with this. But don't worry, you won't have to use it.
I think that that central banks around the world, they recognize that after the launch of Bitcoin, that there will be private alternatives that might take some of their market share, but also that of other government monies might take some of their market share. And so there's this push to be innovative and to protect your market share, even if it comes at the expense of the people who are using your money. So I think that's largely what we're seeing today with all of these central banks being interested in central bank digital currencies.
That makes a lot of sense to me. So just, coming back, bringing it all together here, do you think that there are any things that people can do personally to insulate themselves against the inflation that we're going to see in the long term?
Well, one thing that I encourage folks to do is try to renegotiate their labor agreements. The reality is that if your wage or your salary has not adjusted at an annual rate of roughly 4% per year over the course of the pandemic, then you've taken a real pay cut. That is, your wages today buy fewer goods and services than they would have previously. So you should take that information to your employer and try to renegotiate your wage. That's not easy for some folks to do. So maybe you have to look for employment elsewhere. But that's one thing that folks can try to do to at least undo some of the damage that has been done by the inflation we've already experienced. The other thing is just to think about your portfolio. We're going to experience inflation, above average rates of inflation, probably for the next year or so. And so you want to economize on your non-interest bearing assets to the extent that you're able to. That is, you don't hold much cash. If you can reduce your cash holdings either by buying real assets or purchasing financial assets that will adjust with inflation over time, then that's probably a good idea right now. Because if you're just holding cash, you're locking yourself into that declining purchasing power. And so you want to economize on your cash holdings and other non-interest bearing assets.
Okay, that makes a lot of sense to me, and I'll just put in the caveat that this is not advice that you're getting from. It's not official advice, but just
Yeah, it's
thinking
not
about
financial
things.
advice.
There you go, not financial advice. There's the caveat.
I'm not going to tell you what assets you should buy, but it seems pretty reasonable to expect that cash is going to depreciate.
Yeah.
Over the Fed is projecting that inflation will be above 2% through 2024.
So prepare accordingly.
Yeah.
Yeah. Okay, well, that makes a lot of sense to me, Will. Thank you so much for being here. This was a great chat. And if you have any last words that you'd like to say to our viewers, you're welcome to go ahead.
Well, just I would encourage viewers to check out the Sound Money Project at the American Institute for Economic Research. We write pretty regularly for a broad audience. So even if you don't have a background in monetary economics or macroeconomics, we try to aim our pieces towards a broad audience. So follow along, and we'll try to keep you apprised of what's going on the inflation front.
Yeah, that's great. If you're liberty curious, go to AIER.org. Thank you so much, William Luther, for joining me today.
Thank you.